Good afternoon. Thanks for joining today's roundtable, Tech Sector Outlook, Buyouts and Breakups, presented by The Deal and R.R. Donnelley. I'm Mark Aiello, Vice President General Manager for Venue, the virtual data room platform of R.R. Donnelley. During our discussion, you're welcome to submit your questions for the panel using the posting feature to the right of your browser, and if time allows, our panel will address them later in the hour. 2014 was a great year for M&A. The $238 billion mark that was hit was higher than any year on record except for the year 2000, and the volume of deals done finally surpassed the level we saw in 2007. Tech deals drove just over half of that value, with some headline-grabbing mega deals as companies used M&A in order to incorporate music, gaming, messaging, the networked home, and virtual reality into their ecosystems. Meanwhile, such familiar names as Symantec, Hewlett-Packard, JDS Uniphase, and eBay are breaking up in order to better adapt to changes related to mobile, cybersecurity, big data, and cloud computing. To discuss this active tech M&A environment, I'm joined today by Sean Madnani, Senior Managing Director at Blackstone, Jeff Hoffmeister, Head of the Technology Investment Banking team at Morgan Stanley, and Ronald Clammer, Managing Director at OEM Capital. Guys, thanks for being here. So the first question is, two themes that we saw in 2004 for tech companies were lofty valuations for emerging companies and the breakups of some venerable tech companies. We're going in seeding order today, Sean, so I'll ask you to comment first.
Well, thanks for having us all here, Mark. It's great to be back. I definitely think that in the public markets today, there is some inefficiency in valuations. You have some sectors or subsectors that are richly valued and some sectors that are undervalued. As a result of this inefficiency, I do believe we'll see more breakup activity as companies look to capitalize on the valuation arbitrage and unlock value. So expect that to continue in 2015 for sure.
Thanks, Sean. Jeff, do you agree?
I do, and I think to your illusion of lofty valuations, I still think when you look at companies on a growth-adjusted basis, because I think 2014 was also a year where companies delivered a lot of growth. On a growth-adjusted basis, while the valuations overall may seem high, when you look at them historically on peer growth rates, the companies have performed reasonably well and the valuations have been reasonably intact. So I think some of the things that we've seen in terms of the breakups were a result of company-specific issues, right? And then the stock markets generally applauded those breakups that you alluded to before. So I think for the most part, we'll see more of the same.
And Ron, what do you think we'll see this year?
Yeah, I think the trend will continue. Low interest rates bring high multiples. And if interest rates stay low, the multiples will still be high.
Great, thanks. Some of the hot subsectors that we saw in tech M&A last year were messaging, gaming, video, the networked home, and virtual reality. Are these going to remain active this year, or will there be new subsectors emerging as hotbeds for venture capital and M&A? Ron?
Well, I think I saw an interesting statistic a couple of days ago that we have more cell phones in the world than we have people now, with a 70% penetration rate. I think we're going to see the cell phone, or as it's also known as the network personal computer, being in the center of a lot of things. I see movement in artificial intelligence a lot more, and I see such sectors as specialization in test instrumentation and items like that.
And Sean, your expectations for sectors?
Yeah, I think a lot of the sectors you mentioned just now, Mark, are very consumer focused. So in some of those sectors, we'll see continued consolidation like gaming. But other sectors, I'm not sure we'll see as much, particularly because they've already been consolidated or the leading players have already been acquired. Other sectors I think that are interesting are things like semi-cap equipment, where there's a highly fragmented market, and with growing demand, there needs to be some element of consolidation there. I do also think we see certain pending mergers play out in other sectors, adjacent sectors like media, for example, Comcast, Time Warner, and AT&T DirecTV. As we see those mergers play out, there may be some more consolidation in the video and video tech space, including ad tech.
Thanks. Jeff?
No, I think our colleagues have covered it, so yeah.
So Sean, you touched on fragmentation and semi-cap. What are there other more fragmented technology niches? Are there areas that are particularly ripe for consolidation? Jeff, I'll ask you to comment first, please.
Yeah, I think you alluded to some of the sectors we saw last year, and kind of the consumer-focused and the connected home, I think will be a theme as we see more and more companies trying to focus on the intelligence in the home and kind of where does that emanate and how do you become a larger portion of people's lives on a daily basis. I think you'll also see, you've historically seen a lot of activity in the enterprise space, and that's enterprise software, enterprise security. The security market is one where innovation is it's hard to maintain at the highest levels by some of the biggest companies. Some are very good at it, but there's a lot of startups that are able to be successful in kind of emerging threats and technologies. And so there's been a lot of public IPO activity in the security space. I think that will breed some M&A. And I think one of the other themes you've seen in the IPO markets over the past couple of years is the vertical software companies. Software that targets a specific industry vertical. Those will be more and more interesting to some of the largest enterprise software providers. So you may see some of that in the coming years as well, I think.
Great, thanks. Ron, what are your thoughts?
Yeah, I think it'll be software. That's always the thing. It's easy to start up. There's very little cap requirements. You've got talented people to put it together quickly. So it's going to be around software.
Sean?
I think that there's been a large amount of funding going into technology in the VC realm. And so we've had a lot of startups that are internet-based, for example, mobile app-based, things of that nature. And I think there's a proliferation of startups that will need to be consolidated in order to just remain solvent in the coming year. So expect many of those smaller scale startups to really look for permanent homes.
Great, thanks. Shareholder activism played a role in some of these cases. How big of a concern is shareholder activism in technology? Is this an issue primarily for legacy companies or for anyone with stockpiles of cash? Will activism continue to drive divestitures? Sean?
Well, we've clearly seen activists take a leading role in the market today, and we're seeing a lot of success that they've had. As a result of that success, investors have put more money into that asset class and into that strategy. So I expect the activists as a broader group to continue to push for changes in the market today. And frankly, quite often activists are painted as bad guys, if you will. But in today's world, investors sometimes see them as really as good guys or catalysts for change where otherwise change wouldn't happen. So I expect activists to continue to remain vigilant in some of their campaigns. And we have to remember that it's not just about pushing for M&A activity that activists push for. They sometimes push for changes in management, executive compensation, divestitures, margin improvement. There's a whole host of things that they can help to affect, and I do believe that that will continue throughout the year.
Great, thanks. Jeff, your thoughts?
Well, I'd add the other impact we've seen a lot is the boards themselves, even if they've never heard a single hint of an activist in their stock. Boards themselves, I think, are being more proactive in thinking about some of those issues. I mean, as Sean alluded to, it's not just stockpiles of cash. There's a bunch of different things that I think management teams should be applauded for, boards should be applauded for trying to proactively think about how should we think about this business unit which maybe doesn't fit with the whole, how should we think about this cash position, how should we be thinking about what we're doing overseas. And I would say the level of dialogue that we have with boards where they're proactively coming to us and saying, hey, this is something we're thinking about. It's not because we have any activists in the stock, but this is just something we're trying to be very mindful of, and we are our own best agitators, and so we're seeing a lot more of that. So I absolutely think there will be a lot of change along those lines.
Great, thanks. We've seen enterprise technology companies use both aspects of the M&A process in order to break off disparate parts of their businesses and also to enter new industries, like Oracle picking up Micros to serve the hospitality and retail markets, and Cognizant picking up Trizetto to serve healthcare. How do you expect enterprise software groups to target more verticals? Jeff, I'll ask you to comment on that one first, please.
Yeah, I alluded to a little bit before that in terms of the IPO activity over the last couple of years, we've seen a lot of companies go public which target specific industry verticals. I mean, Opower, Viva, Cvent, et cetera. I mean, there's a long list. And so they're bringing about a lot of change in their industries, and some of the big enterprise software companies, well, like, Oracle obviously has its own strategy, and you alluded to the Micros acquisition, and you see businesses like IBM, HP, SAP, which have historically taken more of a horizontal view of their solutions, but have said, how do I take this technology and apply vertical specific solutions to what I'm going to my customers with? That theme will continue, right? And we're seeing it globally, not just here in the US. So it will be a combination of M&A, but it'll also be an element of just adapting the solutions you have to make them more, I shouldn't say shrink-wrapped for individual industries, but better suited for what those industries need.
Great, thanks. Sean?
I think healthcare as a vertical will be a very popular one in the enterprise software space. We'll see a lot of changes both from the regulatory side as well as just healthcare technology, which will probably drive a lot of that consolidation and focus on that vertical from an enterprise perspective.
Great, thanks. And Ron, your thoughts on
Yeah,
verticals?
I agree with Sean because one of the big things that larger companies have is they control the distribution channel. And in healthcare, the distribution channel is getting shaken up. And it leaves a lot of opportunities in healthcare.
Thanks. So switching gears to talk about IPOs for a moment. What sectors do you expect to be most active this year in terms of IPOs, Jeff?
I don't see any significant breaks from what we've seen in the last few years. When you look over the last 4 years, we've seen, just in terms of sheer number of tech IPOs in the US, or I should say on the US exchanges, it's been kind of high 40s, somewhere between kind of 45, a couple years low 50s. But it's been pretty consistent in terms of volume, and it's been mostly internet and software and things focused on the enterprise. I mean, there's been a couple security deals each year. Last year there were, there were IPOs like Mobileye or GoPro, which don't really fit into a nice, neat technology sector, but they're certainly technology companies doing very interesting things. I think we'll see a few more of those situations this year. I wouldn't necessarily call them one-offs, but things that don't fit in a perfect little bucket or categorization, if you will. But we'll definitely see a lot more software. We'll see a lot more internet. I think we'll see a fair amount, to my earlier comments, security deals this year. So pretty consistent with what we've seen in years past.
Great, thanks. How significant was the Alibaba IPO to this space? Did it change the way that emerging companies and VC backers look at the IPO market, Jeff?
I mean, Alibaba, their IPO is kind of like the Facebook IPO, I think, a little bit, in that it's somewhat of a unique animal, so to speak. But having said that, I certainly think Alibaba's drawn more attention to China. And we've seen more VCs that historically, as firms have been focused on the US, either putting partners in China or just spending more time thinking about that opportunity. Do I think that Alibaba has changed views on valuations or business models or anything of that ilk? I don't, but it's obviously a great company, and it's caused people to take notice, but I think it's more kind of thinking about the region as a whole. So how should I think about the next stage of investments?
So Sean, any other thoughts on the impact of Alibaba?
I agree exactly with what Jeff just said, and frankly, looking at Alibaba today, it's very interesting to notice that it's larger in size than both Facebook and Amazon. It's a truly global company. It's an anomaly in terms of its size when it IPO'd and the size of its IPO. And I think it is adding an interesting dimension to the market now with Yahoo's recent announcement to potentially spin off their stake as a public company, their Alibaba stake, I should say, as a public company. And so that could add an interesting dimension to the market if that actually happens, where you have Alibaba trading in and of itself as a public stock, and a separate public entity that holds Yahoo's stake also simultaneously trading as a public stock will add a unique dynamic, potentially some arbitrage opportunities. So we'll see how that plays out over the course of this year.
Great, thanks. The time from a tech startup's launch to an IPO seems to keep getting longer. Companies like TangoMe have organized pre-IPO stock sales so that employees can tap the value of their options. Why are pre-IPO lifespans getting longer, and how much of an effect has the Jobs Act had? Jeff?
Well, I think on the first part of what you've seen is just more available capital in the pre-IPO stage. And it's in the last couple of years, it's been largely a function of some of the so-called crossover investors. A lot of the funds, the Fidelity, T. Rowe, Putnam, Wellingtons, et cetera, of the world, that historically did not do a lot of private investments, they're doing more, and that is giving private companies the ability to wait a year or two before going public. And so that's certainly had an impact. When, at least as we track it, when you look at the number the amount raised in the private capital markets in tech last year, it was almost 3x what we are in 2014 versus 2013. And it's gone up meaningfully, and we don't see that pace slowing down. And so I don't think it's a function of the companies developing at a slower rate. It's just kind of their entry into the public markets, I think, has sometimes been delayed for doing that pre-IPO round.
Gotcha. Ron, your thoughts?
And it lets them stay out of the public eye.
Yeah.
So they could do things. I think particularly where they're looking for first mover and they want to establish themselves very hard without being a public company.
Sean, any changes in the pre-IPO phase?
I think we're seeing a new class of company that may never IPO, that has a large private market valuation that continues to grow. And I think the Jobs Act certainly helps prolong the timeline before someone has to IPO or inadvertently trips the threshold to file publicly. So helps create that new class of company. I guess what I'd be curious about, and maybe asking Jeff, since you're the IPO expert in the room, Do you see a difference today in terms of the size of offerings on average in the tech sector in the public markets when they IPO versus historical years?
No, the sizes are pretty consistent, and we actually track the average size of a company. And when you go back in the 90s and you look at the first half of this, or I should say the 2000s, on average, companies were doing about 25 million in revenue in the quarter. It's moved up a little bit the last couple of years. Last year, the median in the quarter in which the companies went public was 33 million in revenue. And the median growth rate was actually 48%, so almost 50%. And there's been some fluctuations in the level of profitability. Last year, the median company actually was losing money, high single digits on an EBIT basis. But the actual size of the company has been pretty consistent between, call it 25 and 35 million in quarterly revenues. There's always anomalies, so I quote the median rather than the mean in order to kind of get rid of some of the skewing of the data. But it's pretty consistent, actually. So.
Thanks. A question you guys probably get asked often is, are we in a bubble? And if so, when is it going to end? Sean?
I definitely think we are in a prosperous time right now. There's a lot
of bubble.
It's hard to use that word because bubble implies that at some point it'll pop, and that means a very dramatic end.
Right.
And I'm not sure that I can predict when or if there will be a dramatic end. But I do think that there's a lot of exuberance in the market today. Macroeconomic factors certainly contribute to that. Interest rates, searching for growth on a global basis and where to park your money. Equities being potentially more risky but more return than fixed income securities. And so I think all of those lead to investors piling into tech stocks and driving up valuations. So I certainly see there being a frothy environment in specific subsectors of technology for sure.
Great. Ron?
You never know you're in a bubble till you're out of a bubble. I think that the problems will be more geopolitical that will disrupt the industry rather than anything in the industry or interest rates or things like that.
Jeff, your bubble thoughts?
I made an allusion before to the growth rates of a lot of companies, and I actually, just in response to Sean's question, I quoted some of the growth rates we've seen in IPOs, and it's kind of across the board. We've seen technology, we've seen it in software, we've seen it in other elements. Technology bleed into other sectors where historically there was limited technology. And so I think some of the growth that we see in the tech sector isn't that there's been a change overall in terms of some assumption about geopolitically or on a macroeconomic basis we're going to grow at different rates. I just think tech has been, the famous quote, software is eating the world, right? So we've seen some of that, which has led to higher growth rates. When you look at the valuations, though, on a growth adjusted basis, and you look back over the last 15 to 20 years, I don't think they're out of line. I mean, we certainly in the end of March saw a pullback in largely in the enterprise software space in terms of some valuations for a host of reasons. But it was a pullback. It wasn't things going to 20% of the original value, which we saw in the bubble. So I agree completely. We never know we're in a bubble until we look in hindsight. But the other thing too, though, is and I quoted the number of IPOs. I mean, kind of 99 and 2000, you had over 200 IPOs. In the last few years, we've been kind of, again, high 40s. So I think you see all the various capital markets have been open over the last kind of 12 to 18 months when you think investment grade debt and high yield debt and the IPOs and M&A. So you've seen a lot of activity across silos, but I don't think you've seen the frenzy involvement of the retail sector or other things which causes concern.
Right. So overall, it sounds like consensus is a prosperous but sustainably prosperous sort of time.
Yeah,
right?
but
last
We
word.
think so. Yep.
I'd be curious to hear, Ron, your thoughts. I agree with you in terms of some sort of geopolitical event could be a catalyst to change the market valuations today. We've seen sort of fairly robust market, though, through some trying times around the world, right? Whether it's issues in Russia or whether it's ISIS or Middle East conflict, et cetera. And the markets continue to withstand and sustain. What geopolitical issue do we think the market wouldn't be able to withstand?
Well, my biggest concern is China. I mean, fundamentally, China is a dictatorship, and we have a lot of semiconductor assets in China. They're not owned all by the Chinese, they're owned by American companies predominantly, but they're there. And that will be disruptive. That'll be the black swan that could do it.
Interesting.
A year ago at this time, the sense was that tech groups that hoarded cash overseas would make international acquisitions in deals like Microsoft's purchase of Mojang. But last year's highest profile deals were acquisitions of US groups like WhatsApp, Beats, and Oculus. Do you expect to see renewed overseas M&A, or will US companies bite the bullet and repatriate cash? Sean?
I think there's always been an element of overseas M&A, and that'll continue. However, I don't think companies are going to do imprudent things like spend money just because it's overseas on assets that are not highly strategic. So I think that the overseas M&A will continue to be very focused and very targeted, and I don't think companies will really bite the bullet and just repatriate cash unless there's some sort of tax holiday. I think they'll either use that cash to reinvest in themselves or hold on to it until they find an asset that's truly strategic that they want to own. So I think that there will be continued activity overseas and cross-border. It'll just be very focused.
Thanks. Ron, your thoughts on cross-border?
Well, I think that you have to look at the strong dollar and what it's doing on assets overseas. And particularly some European countries start to look very attractive, particularly Germany. Other things is I think Canada as a tech platform has been understated. Although it's a small, the government does give a lot of subsidies for engineers on payroll. So, you know, that's an opportunity. And some of the Scandinavian countries, particularly in the software space.
Jeff, what are your thoughts?
No, I think my colleagues covered it well.
Okay, great, thank you. 2 years ago, we had the LBOs of Dell and BMC Software. Private equity was less ambitious last year, though. Do you expect private equity to continue to target middle market tech opportunities, or will there be more mega deals? Ron, I'll ask you to comment first.
Well, I think it'll be smaller deals. I mean, you can only do so many mega deals. We've seen private equity moving down market. We've seen private equity moving into more specialization. You know, 5, 10 years ago, in the tech sector, private equity that was not affiliated with venture capital was comfortable in contract manufacturing, cables, connectors, things like that. They're now venturing in instrumentation and some of the verticals as well, to be into a freer competitive space for them on valuation. We also see them picking up a lot of the VC companies that they wouldn't have looked at as they've gotten larger. So the number of private equity firms, deals buying into VCs have about tripled in the past 4 years. So that's an opportunity.
Thanks. Sean, what are you seeing?
I definitely agree with Ron's sentiments. I think that we will see continued private equity activity in the tech sector. It'll be more focused in that middle market or lower end, if you will. Many funds have really either just completed a fundraise or in the process of completing a fundraise. So the sector, the asset class, private equity, is awash with cash, lots of dry powder that has to be used. And it's a matter of finding areas where you can actually achieve a good return. And that means taking advantage of inefficiencies. A lot of those inefficiencies happen at the lower end or the mid-market areas. I think the larger cap mega buyouts will happen, but they'll be few and far between. Those mega buyouts are obviously require a lot of capital and maybe tougher to execute in the long term.
Great, thanks.
Yeah, I mean, and building on 2 points of Sean's and actually one of Ron's, I think on the cash piece, there's also a big inventory of companies in the portfolios of the private equity shops. It's as high as we've ever seen it. And so you combine that with the trend that you see more and more transactions where one private equity firm is buying it from an asset from another private equity firm. So you combine the inventory and the cash balances, and so I think we're going to see a lot of that. You've already seen a lot of that activity here in 2015 already, and that will continue. And overall, you've just, to build on one of Ron's comments, we do see a lot more firms going, quote, downstreams in terms of smaller checks than they would have written in the past as they think about more venture type investments and where that takes them. And so we see a ton of activity. I mean, it's still largely going to be a situation where if a private equity firm is competing for a, quote, strategic that can bring significant synergies to the table, right, that makes it tougher for the private equity firm, but we expect a lot of volume out of them.
Great, thanks. How much would an increase in interest rates affect tech M&A and private equity participation in auctions? Sean?
It would definitely have an impact. I think it's a function of how much interest rates rise and over what time period. I think a gradual multi-year increase in interest rates, private equity as an asset class will be able to adapt and adjust accordingly. However, a big spike in rates over a compressed 3 to 6 month time period, that would definitely dampen the activity from private equity's perspective.
Jeff, your thoughts on interest rates?
Yeah, no, I agree with that. As we all know, interest rates are a driver of the available debt, which firms could put to work in terms of thinking about the acquisitions they would do. I don't see interest rates going up meaningfully anytime soon, but I'm not a global economist. I will build on Sean's comment that if we see a rapid rise, I think that will change things. But there's also, there's a lot of things in the work, and there's a lot of appetite for it, and so. All things, and again, to my earlier comment, they're not going to beat out, quote, strategics if some strategic can bring, synergies equivalent to a quarter of the operating expenses of the target. That's just going to be tough for a private equity firm to compete with. But I expect a lot of volume, and the interest rates can impact the debt, but that would be it.
Great, thank you. AOL CEO Tim Armstrong said recently there are probably 200 to 250 companies and room for not so many. Do you see it consolidating to Google, Facebook, AOL, and a few others? Or do you think that there will be, I'm sorry, this question came in from the audience and it seems to be cut off there. So I think while we pick that one up, maybe we'll just go back to the questions that we had up on the prompter. Let's turn our focus to an issue of global concern in the tech industry, cyber breaches. How does this affect the sectors that you watch? Do you expect to see consolidation among the hundreds of cybersecurity startups that have arisen in response to this pervasive threat? Jeff?
Yeah, so one example is we saw the acquisition of Mandiant last year, right? And that was the definition of a security company focused on the cybersecurity issue. Security as something which in the daily nomenclature, the daily news has become more and more prevalent, right? We can all quote a bunch of examples of well-regarded, high-profile companies which have been breached in some form or manner, and a lot of times they're very, very sophisticated, quote, attacks. And so companies trying to stay up with that, not only just in terms of pure security companies, but anybody that deals with, whether it be customers in any form, whether you're dealing with enterprises as your customers, consumers as your customers, you have to be really cognizant of not only how do you have outside vendors that help you provide a more secure solution, but you got to bring some of that in-house too and really, really know what you're doing. So we see organizations of all forms staffing up in terms of their ability and expertise on this. So.
Sean, your thoughts on cybersecurity?
I think it's, Jeff is spot on with his opinion. I agree with that. I think in a world where cyber warfare is a reality, security becomes even more important, and I think the consolidation will happen not just amongst security vendors themselves or amongst enterprise software players looking to sort of augment their solutions, but non-traditional companies as well, in fact, infrastructure providers. So recently, in speaking to a large owner of subsea fiber, they said security is their top priority in terms of M&A, and the reason being that if there is some sort of cyber attack or cyber warfare that happens and the data is being carried over their infrastructure, their fiber, they don't want a government to turn around and point at them and say, your lines were not secure and that's why this happened. So there's going to be buyers of all shapes and sizes who have interest in security and owning assets themselves.
Thanks. Ron, your thoughts on companies that could benefit from
providing
cybersecurity?
Yeah, I think my perspective is much more towards the Lockheeds of the world. They're very close to the government, which has a substantial effort in cybersecurity, and that particularly the marquee names would want to use a Lockheed rather than a startup. Mm-hmm. So although startups can benefit because if you have a solution that's not terribly well known, it's reasonably safe, and then you migrate up to something that's well known and it starts to get attention. Right. So I tend to think it'll be more of the big companies that are in defense dominating this business.
Interesting, thanks. Tim Cook predicts that 2015 will be the year of Apple Pay. How much will companies like Apple and Google change the payments business this year? Do you expect more entrants, Sean?
Well, I admired Tim Cook's confidence. I think the success of Apple Pay specifically is going to be a function of penetration of Apple devices and proliferation of their devices, particularly in the US and developed markets. But payments, the sector as a whole is clearly very lucrative, profitable segment, but it's also very crowded. So there's lots of players who are competing for this piece of the pie, if you will. And to that end, I expect the traditional payment vendors we've seen, whether it's MasterCard, Visas of the world, or even PayPal, being aggressive and looking to make sure that they maintain or increase their market share, and perhaps doing so through M&A and consolidation.
Ron, your thoughts on the payments industry?
Well, I think it'll be driven by where the card is presented or where the phone is presented, and the applications and appliances that they have there. And it could be, I happen to think Apple Pay's competitor is more of the chip and sign that they're instituting on cards here with Visa and American Express and so forth. But things go slowly in adoption.
Great, thanks. The Apple Watch is due out in early 2015, and Microsoft is introducing the HoloLens, while Google is backing off from glass. So what do you make of the wearables market? Is 2015 a breakthrough year, or are we still at the drawing board? Jeff?
Yeah, I think the wearables space has received some hype around it, but the products continue to improve. The features continue to improve. The adoption continues to improve. And so do I expect 2015 or even necessarily 2016 is going to be a year where we see a ton of IPOs or M&A activity? I'm not sure that we see that. But there is, I mean, for people that were at the CES show earlier this year, I mean, there's a lot of activity around this space, and there's some really interesting products. And so as that technology, as that functionality continues to evolve, I think we're going to see adoption rates continue to go up, right? I mean, you always, for things like this, you always have kind of the wave of first adopters that kind of spread the news, and then companies adapt their products to kind of have it to kind of mass use. And so while there is maybe a little bit of hype around it, I think the long-term trends are very positive on wearables.
So, Sean, do you agree?
I agree. I think the key in what Jeff just said is long-term. Clearly, none of us in the room are early adopters. I don't see any wearables. Unfortunately, but I do think that we're in the early innings here. I don't expect to see a lot of M&A activity amongst wearables unless and until we really figure out the use cases that make sense and the monetization models that make sense, and that could really take some time. So great innovation, great technology, just needs to find the right ways to apply it.
More of a long-term sort of play. Great, thanks. Is cloud infrastructure in danger of commoditization, and how can the players in that space differentiate themselves? Ron?
Well, I think that it is. I think it is moving in that direction. My feeling is that it's the communications channel that they can deliver as well, because what do you fear most about cloud? You lose your internet connection. I mean, that's basically it, and your server's not down the hall. So that needs to be done, and I think they could do it if they move in that direction.
Sean?
I had a nightmare once that I lost my internet connection. It was terrible. No, I think Ron is correct. I do think there's an element of commoditization amongst the cloud service providers and infrastructure providers. I think the way that they will combat it, and what we've seen, is a move into more value-added services. So whether that's having a proprietary security offering for their customers, a proprietary CDN offering for their customers, or as Amazon just announced, doing hosted mail to compete against Microsoft and Google. It's really branching out beyond just being a pure infrastructure provider to add more value.
Great, thanks. Last March, we saw a pullback in the valuations of high-growth enterprise software groups. In most of these cases, there wasn't a real operational problem, though. Many of these companies recovered as the year went on, and we've seen IPOs from Hortonworks and others. Do you think the market is more comfortable with these kinds of companies now? Jeff?
Yeah, I think what we saw in March was to use your word, pullback on some investors' view on the importance of profitability versus growth, right? I mean, for the tech IPO markets, for the tech markets overall, growth has almost always been the predominant driver of valuation. Obviously, there's a host of things which go, margins and quality management team and the market and the opportunity all go into views on value. But growth historically has been the key driver. And we were growing, or we were focused pretty unabashedly on growth in the first half of last year, or in the first part of last year. In March, we pulled back a little bit. And as you saw investors spend a little bit more time focused on the margin question, it did get a pullback in some of these stocks. To your comment, though, I could completely, there weren't fundamental changes in the operations of these businesses. I mean, these were all great businesses. We saw it mostly in the high-growth software space. And so while some of the valuations came back 15, 20, 25%, some even more, they did get back through the year, and you saw IPOs at the end. You mentioned Hortonworks and businesses like HubSpot and New Relic. There was a lot of good IPOs of very strong enterprise software companies, and so it was just that. It was pullback. It was not a view that valuations need to adjust by 50, 60, 75%.
Great, thanks. IBM and Twitter announced a partnership last year. Do you expect the large enterprise software groups to make a bigger position in social media? And how would they do this? Through partnerships, acquisitions, or through their own organic growth? Jeff?
Yeah, I mean, we've seen, when you mentioned the IBM situation there, they obviously also did this big partnership with Apple, right? And so it is, in my view, going to be more partnerships than anything else. And a lot of it just goes into the functionality. I mean, as you allude to Apple, you know, Apple was one of those products that started primarily in the consumer, and it worked its way into the enterprise. As we all, as workers, were taking these products we were using in the home, and we were taking them to our workforces. And we see this with social as well, right? And a lot of the new software that is coming out, there's obviously the mobile interface, and there's also the social interface in terms of the contextual awareness and the other features which people want to see in their enterprise products that map what you can get in Facebook or Twitter or other social platforms. And so I don't see one of the big traditional enterprise vendors, you know, IBM, HP, Oracle, etc. I don't see one of them going out and buying a big social media company, but I do see them being much more cognizant of having that functionality and that awareness in the offerings, their product offerings, which they're delivering to the customers. So.
Sean, your thoughts on social?
Yeah, I agree with Jeff. I don't think that the large enterprise technology companies are looking to own social companies. I don't think IBM wants to own or operate Twitter, nor do I think Twitter wants to be owned by an IBM. But I do think that there are opportunities for strong partnerships. You know, for example, Twitter has access to such vast amounts of data. IBM has excellent data analytics engine. So to be able to combine those two assets can be very powerful in terms of advertising or generally analyzing trends. So I do think we'll see more partnerships. I guess you have to also think about it how social is applied within the enterprise. Microsoft obviously owns Yammer, and they created sort of the social enterprise aspect. I do think that there's a place for that. But to your broader question around the Facebooks of the world, maybe being owned by large enterprise companies, I don't think that there's M&A in store. I think it's much more partnership. I did want to maybe go back a second and ask Jeff and Ron also a question, which was, we talked a second ago about valuations and growth and the pullbacks, so forth, and maybe Jeff from an IPO standpoint, Ron from an M&A standpoint. I get this question a lot, so I'm curious to hear your thoughts. What do you think investors and acquirers value more today? Do they value growth, or do they value profitability? And how do you think that correlates to the values that they're paying?
Ron, you want to start?
Okay, I'll start. I think the growth aspect has to do with first mover. In other words, that can you get and dominate a space? If that's not the case, I think it's future profits and cash flow, definitely.
Yeah, I still think growth by far is the key determinant of value for businesses, whether it's in an IPO context, whether it's an M&A context. I mean, that's still, I think, Sean, what drives them more than anything else. I do think, to some of my earlier comments, margin and other things are coming back into it. I mean, when a large enterprise is thinking about acquiring another enterprise, they obviously think about what that does in the growth rate, but they're trying to model out, of course, how margins, as you know very well, how margins and everything else play out. But tech is one of those segments which in some ways is almost defined by high growth rates. And as things slow down and become a 2%, 3%, 4% grower, there's a lot of things that maybe they're on the borderline of tech in another industry, and they end up gravitating more just in terms of their following to those other industries. And so tech almost I think definitionally just attracts growth and how people think about it. And I think that's true of all the great tech IPO investors out there as well. So.
Interesting. Well, guys, we do have time to take some questions from the audience, and I think we'll pick up that question that was cut off a bit earlier. AOL CEO Tim Armstrong said recently there are probably 200 to 250 companies in ad tech, and room for not so many. Do you see it consolidating to Google, Facebook, AOL, and a few others, or do you think there will be niches where mid-sized companies can thrive? I don't know which one of you guys would care to take that one first.
I'm happy to start. I mean, I think, especially in New York, we see a lot of this in the ad tech space because you have a lot of the media heritage in New York, and that's blending with the tech expertise, which is burgeoning here a lot in the New York area. But you see some great ad tech companies, obviously, all over the planet. It is an earlier stage of formation, right? And so there are a lot of companies, there are a lot of different business models. Will it consolidate? It will. Does it mean that they're all going to get wiped out? Of course not, right? I mean, you can make a parallel to the enterprise software space. The Oracles and IBMs and SAPs of the world provide some great software. There's hundreds of other companies that provide great software as well, and they interplay and they provide different functionality. And so I do think most people that follow the ad tech space closely do see a fair amount of consolidation. That's both M&A activity as well as just consolidated among some of the equal-sized companies. And as this sector evolves, and companies like Google and Facebook have phenomenal offerings in kind of the advertising space broadly defined, but there will absolutely be opportunities for other companies.
Ron, Sean, any thoughts on consolidation in ad tech? Or?
Well, with ad tech, everyone's looking for that consumer that tends to be young and very switchable. So I think that I heard a comment on Facebook is, gee, my mother's on it. I think I'll have to find something else. So there'll be always room for more companies.
Thanks. Next question is, with companies staying private longer before an IPO, which Jeff, I think you might have said is not exactly the case, but has $1 billion become the measuring stick for VC-backed companies?
You certainly see a lot of the various periodicals which will publish the list in terms of how you do the cutoff for the best private companies out there in tech land. The $1 billion valuation has become kind of that new cutoff point for a lot of people. Obviously, there's a lot of different things you can do in a private company valuation in terms of whether you're giving common or preferred and liquidation, like all kinds of different mechanisms and structural events where $1 billion valuation for one company is not necessarily equivalent to a $1 billion valuation for another company. There's been a lot of companies that have achieved it, and as we talked about before, some of it is that you have a new class of investors in the private company space than you've had before. Some of the traditional public IPO investors have been more into the crossover category and provide some more capital there. You see a lot more in terms of family office money. You see a lot more in terms of sovereign wealth money. There's just greater capital to be put to work, and so some companies, they're staying private longer. I mean, to one of Ron's comments when we were addressing a similar question before, there are just certain hassles about being a public company, and certain boards and management teams, all things considered, would prefer to wait a little bit before you have to go through that. And I guess the last point I'd make on this is you are still seeing, I think in many people's minds, a little bit of a disconnect between private valuations and public valuations. And you certainly have seen some IPOs where the public valuations, which they see from the public markets, maybe at pricing have been less than, for example, a round they did before. Now a lot of those stocks went public at one spot, and obviously as a company has continued to perform, the stocks have reacted accordingly. But there's a lot of capital at work in pre-IPO companies right now.
Yeah, I sort of building on what Jeff just said, I have a fear that a lot of the private companies that have billion-plus dollar valuations, if they do try and go public, the market may not support those valuations. So it'll be interesting to see how this plays out. I think it's one thing to have a private market valuation that's great for the VCs and their marks on their books, et cetera. But when you actually try and sell it to a broader investment base, that's when you actually will test the true appetite and valuation. And I'm not sure that all of them will stand up to the private market rounds that are being done.
Thanks. How do you see the increased strength of the U.S. dollar impacting M&A in 2015? I don't know, Ron, would you care to take that one first?
Well, as I said previously, I think that a number of larger European companies should be running to the U.S., not walking. And so that's one impact. The other impact is the use of the dollar for stable countries abroad that have truly lower variable labor and are not encumbered by a lot of social overhead.
Any other thoughts? On
We talked earlier a little bit about this, and Ron had some good thoughts just now. I think when we talked about it, though, we talked about U.S. companies doing overseas purchases, and obviously with the dollar being stronger, we addressed that. If I think about the other way, where for a while we've had, for example, Asian companies, Japanese companies looking to purchase in the U.S. with their currency weakening, and I believe will continue to weaken over the course of this year, I think we'll see fewer of our domestic companies in the tech sector being bought by overseas companies. So it may change some of those trends that we saw over the past 12 or 18 months.
Great, thanks. With companies taking longer or even not considering IPOs, how does this influence the exit strategies for private equity firms? And Sean, as the private equity guy in the room, I wonder if you wouldn't mind taking that one first.
Well, I think I would say from a private equity as an asset class, when it looks to exit investment, the preferred route is always M&A because it's a full exit, if you will. And frankly, an IPO can be a partial exit, and it can be a great one, but it may not always be the preferred route. I think right now, the appetite in the public markets for tech assets is strong. So if you can achieve some sort of liquidity, and that too at a premium valuation via an IPO, you'll see private equity pursuing that route. Of course, if they can get an outright sale at a premium valuation, they'd strongly prefer that.
Thanks.
Well, and I'd add too, I think we're seeing more private equity firms get more and more comfortable with the dividend recap strategy as a way to, it's obviously not ultimately an exit, but it's a way to get your returns a little bit on an elongated timeline. But I think for a while there was a period of time where people were focused on either it's M&A or it's IPO. And to Sean's comments, the problem with the quote IPO is that the actual liquidity, in terms of full liquidity, just takes longer, right? And I think people are viewing now more of a little bit of a third option of how you get your capital out. And it's always been there, but I think people are just being a little bit more aggressive on it. And again, the inventory is as high as we've seen in a long time. So there's going to be a lot of people pushing for exits.
Great, thanks. Ron, earlier you spoke about smartphone penetration. Do you think that growth in China and Asia will compensate for a saturated U.S. for the component market and phone makers?
Well, I think that what'll happen is the penetration is on all phones. So smartphones are still growing in share. But the smartphone aspect of it will become a component in a system. I mean, you have a portable computer that networks. And so more and more people will be using that, and that'll be driving it. What happened with phones in China was interesting because initially Samsung got clobbered by the low-price phones made in China. And then Apple comes out with large screens and sells 75 million phones in a quarter. So it's interesting what's happening there. But China is becoming more protective. They really are favoring more and more of their own manufacturers. And unless there's a cachet or an ecosystem around something else, that's where they will go. So that's it, yeah.
Great, thanks. Acqui-hire has become a tech buzzword. Often the target company dissolves and the buyer gains engineers or talent. How meaningful are these deals? And is there a way to evaluate them? Guys, I don't know which one you would care to take that one first.
Sure, I'm happy to dive in. So acqui-hires are a buzzword. You are seeing a lot of them. And I think sometimes the nomenclature encompasses acquisitions of companies that do have a product, but it's just not received a ton of traction yet. And this is a way of one company to diversify into maybe a tangential segment where their product currently doesn't address that segment. Engineering talent is as important as it's ever been. And so an acqui-hire gives you an opportunity to get some very, very talented team members. And so we've seen a lot of it. We'll see a lot more of it. It's a way to enter new markets. It's a way to, with the talent that you're acquiring, enter those new markets, but also improve what you have right now. And I think there's a growing recognition that buying another company that has a competing platform and trying to, quote, jam those platforms together can be problematic, time-consuming, and painful on customers. And so the acqui-hire is a way to have a little bit longer-term view on how you do that. So.
Thanks, Jeff.
As a guy in Silicon Valley right now, just sort of looking around, it's amazing to me how much there is in terms of demand for talent and talent all throughout technology, whether it's business talent, whether it's engineering talent, whether it's HR talent. There's so much demand. And so I see the large companies who just can't hire enough, looking at acqui-hires as a way to just grab talent. It happens very often. It happens quite often in the early stages of companies that haven't really put out a product yet. But you have a bunch of really smart guys, and a large company may say, "I'm not really all that keen on the platform they're building in the long term, but I really want these smart guys, so I'm willing to pay for them, and whatever IP comes with them." It happens a lot. It happens beneath the radar, so it's not always in the press. And I think it's quite common. As I take a step back and I think about deal making, I'd appreciate your guys' observations. When you think about large corporate acquirers today, and we all shuttle around the globe frequently, do you see a difference in mindset between East Coast technology companies and West Coast technology companies in terms of how they're approaching M&A?
I personally don't. I mean, there's definitely, as you allude to, different cultures in many cases. So that I think that impacts. Sometimes you'll have a company which says, like, our culture is so ingrained in, quote, this coast that for us to acquire something on the other coast would not make sense. But is there a different view in terms of things that you would buy or valuations or views on how you add value? I don't see it, Sean. Maybe you do. So
Yeah, I think as long as you don't move the engineers, it doesn't matter. So that's basically what it was. I remember selling a company in San Diego to a company in Alabama, and the guy said, "How many people will move?" And I said, "Nobody." And he said, "Why?" I said, "It's San Diego." But engineers, they're not moving these days.
Right.
So that's why the Valley has such a competitive advantage. You don't have to move too far.
Right.
Although the traffic is hell.
You're telling me. But do you also think, Jeff, from an IPO perspective, when companies are thinking about should we IPO or not, do you think that East Coast companies think about it differently than West Coast companies?
I don't. I mean, I think a variant of your question or the issue is that I think sometimes a lot of venture investors on the board will say to an entrepreneur who's maybe located in a geography which is not known for such strong engineering talent to say, you need to come to the West Coast, or you need to come to Boston, or you need to come wherever to access a better pool of engineering talent. Sometimes that makes sense. Sometimes that just means, to our acqui-hire conversation, that I'm going to be paying more to and have better competitions for talent, right? And so I think some companies make that decision and say, well, there's just more people, so that's why I should move. And others say, no, actually, we got excellent people right where we are. We're in Alabama, we got all the Georgia Tech or whatever graduates we need. We don't need to move. And so I think we see that some, but I don't think we see a difference in terms of how one thinks about the IPO path, candidly.
Okay, thanks. Guys, we have time for one final question. The software as a service model keeps growing to new industries. Will this continue? Are there some parts of software and IT where it doesn't work as well?
I do think it will continue. I think we've talked a little bit before about the vertical element of software, and I think we've seen a lot, various industries. The insurance industry has seen some of this, the financial services industry has seen this, the healthcare industry has seen a lot with Viva and metadata and et cetera. I mean, there's a lot of companies that have targeted that vertical. We will see more. There are certain applications, though, which are going to be one of the last movers on the SaaS front. I mean, we sit here in New York, and you reference some of the big financial trading platforms. It's software. Do I see a lot of financial trading platform software being delivered in the SaaS model? I don't. Part of it is just the speed of what needs to be done, and part of it is just the extreme sensitivity around the data. And so there are some applications which will be some of the late entrants, if you will. But I think with each passing 6 months, year, as the security gets better, as the speed gets better, the latency gets less, I think you're seeing more and more move to a SaaS model for all the reasons one would suspect. And then you have this interesting stage in the evolution where if you are a large company like a Coca-Cola or a General Electric, sometimes buying under the SaaS model, and that differentiating between the cloud software delivery versus a subscription revenue model. Sometimes the subscription revenue model just doesn't make sense, and people want to say, well, I want to buy this, right? I'm going to be using this for the next 10, 20 years. I don't want to pay you every month. I just want to buy it. So, but the technology evolution in terms of how software is developed, I think, is going to continue.
Well, guys, that is all the time we have today. I really want to thank you for joining. It's been great speaking with you. I've been speaking with Ronald Clammer of OEM Capital, Jeff Hoffmeister of Morgan Stanley, and Sean Madnani of Blackstone. Thanks very much for joining.
Thank you.
Thanks.
Thanks so much for your time.